Everyone's talking about Trump flooding the market in 2026. And here's the real play. It's not just one thing, it's a combo. Cash injections, policy shifts, and energy supply shocks. Some analysts are saying Trump is gearing up to put serious money into the new economy, whether through tariff dividend payments, subsidies, or other stimulus style moves that could boost liquidity and consumer spending. Meanwhile, strategic moves in Venezuela's oil market could unleash huge new oil supply globally, potentially pressuring prices. If Venezuelan oil production ramps up, it could feel like a flood of cheap energy hitting markets, reshaping everything from inflation to energy stocks.
What's good, family? In this video, I'm going to show you how money is about to flood into the market in 2026 and exactly how regular people like you and me can position ourselves before Wall Street does. No opinions, no fluff, a real life playbook that we can use. Now, we're breaking this down into 3 clear segments for y'all. First, where the cash is coming from. It's important for us to know where the money coming from and how it get here. We know the Fed gonna print it, but there's some other ways. Second, why the Fed is quietly amplifying it. And third, which sectors and stocks are positioned to absorb this money. In 2026, a lot of people are gonna wonder why the market ran without them. Not because they were stupid, but because they didn't understand how money actually enters the system. So man, make sure you like, make sure you subscribe, and make sure you just get your opinion in your package. This is one of the ones you're gonna watch a few times. And do me a favor, y'all, help me get this video to 1,000 likes, because that'll truly help the channel and that'll truly help us keep growing the way we wanna grow. Let's get into it, man. This isn't stimulus money. It isn't free money. This is your money coming back, and it's about to change asset prices. Now, hear me out, hear me out. Before we talk about stocks, you need to understand there's a couple mechanics. And the reason why we understand this is because you'll never look at war and you'll never look at tax refunds, rate cuts, or feel the market after this video. I promise you. So I want to get those little mechanisms understand for us. Now, let me show you what's happening and how we can position ourselves before it becomes obvious for everybody. Now, here's what we do understand. Every major conflict ever studied eventually traces back to what? Power. And in the modern world, power comes from energy and oil. So this isn't new. We've seen this before. We've seen it with Gaddafi in Libya, how they control oil outside of Western systems, and they wanted to unite Africa under a currency, gold. You know America didn't like that. Second, we saw it with Saddam Hussein, Iraq, threatening oil price and power. And now we see it with Venezuela. They sit as the largest oil reserve on earth. Now, when a country controls energy outside of the U.S. influence, it becomes a geopolitical problem. Not because of ideology, but because of leverage. And that's what this is all about, y'all. Now, let's think about this. Here's the numbers. Venezuela represents 300 billion barrels of proven oil reserves at about $17 trillion. United States, 68 billion barrels. Venezuela is the #1 global oil reserve in the game, ahead of Saudi Arabia, ahead of Canada, and ahead of Iran. Venezuela isn't poor because of lack of resources. It's poor because, well, energy hasn't been monetized right. You had some government officials in play that wasn't really working the way they should be, and that's why it matters. And so we've heard Trump numerous times say they stole our oil. So he didn't hide his motive in this one. So we're going to have U.S. companies making money from this country's oil again. This is Trump words, not mine. And we'll run things until it's stable. This is Trump words, not mine. That's not a code language. That's a strategy statement. That's somebody saying exactly what they're going to do, why they doing it. Now, this isn't about a regime change for values. It's about reasserting energy influence. Now, we got to think, we got to remember this, y'all. America is going to always be at odds with China. And China has been slowly positioning itself to be a more friendlier state, right? Now, here's the part that a lot of people gonna miss. For years, China has extended billions of dollars in loans to Venezuela. Those loans were repaid in all shipments. So Venezuela became a long-term energy hedge for China. Now, China always wants energy diversification. That helps with AI manufacturing, that helps with data centers, that helps with cheaper power. Venezuela was a future supply pillar for China. Now, any disruption forces China not to really scramble, but it just kind of messes up what they have going on. So now they may have to go back to the Middle East, Africa, Russia, often at somewhat higher prices. Now, here's what I want you to understand. This going on with Venezuela does not hurt China by a big shot at all. Like, they only represented a small part of this. But we did hear China come out and say, yo, we oppose this, yo. Like, we ain't in agreement with that. Of course, they're defending what they have. We should expect them to do that, right? The accusations of sovereignty violations, claims of destabilization, and claims of opposition to U.S. involvement, like, they didn't like it because energy insecurity is a national vulnerability. Now, I need us to understand this. I'm not in this game to be like, oh man, that ain't fair, this and that. Like, I get the people who feel like that, and I'm not on either side. I'm just saying, like, we live in a world where, like, we know what America do, y'all. Like, we've watched them bully for years. We live here and we watch them bully us. You know what I'm saying? And this is the game of power. So I'm just saying, like, we only have control of what we have control of. Now, let's get a little deep into this. AI will require massive data centers, continuous power, redundant grids, cheap scalable energy. Energy isn't the background input anymore. It's the bottleneck. And Venezuela isn't just oil. It's untapped natural gas, massive hydro potential, grid-scale energy development opportunity. Whoever controls energy controls the speed of AI adoption. And I'm telling you, America and China are at the forefront of this thing. We understand energy is going to be a real issue. It's not the AI. It's not the data centers. It's the energy. This is the fight, y'all. And so why this matters going into 2026? Well, this is why energy, infrastructure, and AI are converging. U.S. wants domestic control, friendly supply chains, reduced China leverage. China wants stable inputs, energy security, long-term AI dominance. This is the war for power we seeing happen right in front of our eyes. So Venezuela is not a story. Energy, leverage, that's the storage. That's what this game is about. And we actually see Trump saying, bro, anybody who wants some smoke, we want the smoke. Now, AI needs energy, and Venezuela is energy. And this is why capital is repositioning itself quietly. Now, here's a couple companies who I think will 100% be impacted in a good way by this. One, ExxonMobil and Chevron. Simply being geopolitical energy, like, it gotta flow through them. And so Exxon pulls oil and gas out the ground, refines it, sells it globally. Chevron simply does the same thing. Well, why benefits from Venezuelan geopolitics? Well, when energy supplies are unstable, the biggest, safest production wins. Exxon has the scale, Chevron has the scale, political access, capital to operate where others can't, and any shift to global control comes through them. This is an easy layup for them. Now, when energy becomes power, Exxon and Chevron, one of the few companies that the government can rely on. They've done it for years. It's like Old Faithful. It's like buying an F-150. You know one thing, you're going to get what you're going to get. Number 2 on the list would be Schlumberg's, ticker symbol SLB. Now, they become the picks and shovel of global drilling. Now, they provide the technology, services that make all production possible. Now, if Venezuela, the U.S., or allies increase drilling, SLB gets paid. It doesn't care who owns the oil. Only the drilling is what they worry about. Uses AI and automation internally to get higher margin. So The thing about this is all companies can't scale production without SLB, and that is the leverage. So I like them. Remember, this is just financial education, and this is my own opinion. Do not go invest in none of these things without doing your research, y'all. I'm going to say it again. Do not go invest in none of these without doing your proper research. Next, I see Cheniere Energy, LNG. This is the bridge between energy and AI power. Now, what it does, Cheniere, they export liquefied natural gas, LNG, to the world. Now, AI data centers need 24/7 reliable power. Natural gas is the fastest way to deliver that power at scale. So, when countries fear energy disruption, guess what happens? LLG contracts surge. Now, here's why this is really, really critical. Because AI runs on gas, electricity, and reliability. These are some of the companies that I think truly could benefit for this. Now, we're going to go deep into this because I want to get on some charts. I want to show you a couple of things. But the last company that I got to talk about is GEV Vernova, ticker symbol GEV. Now, this is the grid builder for the AI age, right? This is one of the best moves that GE ever did when they broke these companies up, right? And shout out to GEV, they gave me my $500,000 play in 2025.
Whoop they do.
Got that back. Now, GEV Vernova builds power generation, equipment, turbines, and grid infrastructure. AI data centers are overwhelmingly old grids. So power generation, transmission must do what? Expand. Government and utilities are forced to spend money. This company just keeps beating, keeps dominating. You can't scale AI without rebuilding the grid, and GEV Vernova gets paid to do that. Now that we got that out of the way, let's talk about the second part of why the money floodgates are opening up. And here's why I think, and we see this. So we understand that Trump had what's called the big, beautiful bill. And the most important part isn't the politics. Again, it's the mechanics. So let's take the noise away and get to what's really interesting here, what I saw. The bill didn't just change taxes going forward. It changed taxes retroactively. Now, this is a key. Now, I remember when I was going to court and I was fighting my charges. Anytime you heard the Supreme Court or somebody overturn something retroactively, you love that idea. So what does retroactive mean in real life? It means tax rates were lowered after people already got paid. Employers, well, they didn't adjust the paycheck withholdings. So millions of Americans actually overpaid throughout the year. So when this tax season comes, guess what's going to happen? That overpayment, it doesn't disappear. It'll actually come back to you. That's right. It'll come back to you. That's why I say they're going to flood us with cash. It's your cash. It's not a stimulus, right? Say that again. It's your cash. It is not a stimulus. This is delayed money being released all at once. Now, of course, we know we got a president that's going to say he's responsible for it, yada, yada, yada. It is what it is. I'm not mad at that. I'm glad the money coming, right? Why is this a big deal, though? Well, because on December 10th, Donald Trump said, this will be the largest refund season of all time. And then Scott Besson added context and said up to 2,000 extra per household, estimated to 100 to 150 billion in additional funds. Just let that sink in for a second. Now, that's not no chump change. Again, it is your money that's already owed to you. That's not free money. It's your money. That liquidity hitting the system in a short window, well, that's going to do some damage. And here's the part most people are not going to pay attention to. Money behaves differently when it arrives unexpectedly. We saw that in COVID, right? Refund money doesn't go to bills first, isn't mentally earned. It gets spent, it gets invested, it gets deployed faster. I'm just being real. That's behavioral finance, not politics, y'all. I might know a thing or two. So here's what I'm saying, $150 billion. Think about what that's going to do going into the market, especially because we have people who are now aware. Now, why do markets care? Markets don't care where the money comes from. I got the money.
Whoop they do.
They care when it moves. And this kind of cash shows up quickly. It hits millions of accounts at once. Historically flows into stocks, crypto, consumer spending, assets that are also tied to optimism. Why? We see right now, here's the stat. More Americans are invested in the stock market. What do we hear Donald Trump say? We want to get that up even higher. What do we hear Scott Bessent say? We want to get that up even higher. They said it's in the conference. So that money doesn't sit still. It moves. And when it moves, it looks for assets. So this is how reflective rallies start. Not with headlines, but with cash flow. Now, let's dig a little deep into the big, beautiful bill. Now, it has 7 tax advantages. Why this is about saving? Nope, it's not. It's about spending power. This is a liquidity event disguised as tax reform. I'm going to say it again. This is a liquidity event disguised as tax reform. Let's walk through this mechanically. And I've been using that word a lot because I want us to see this, how like we get through this and putting the politics to the side. One, each of these changes does one or two things. One, put more money in people's pocket or reduces friction on spending. One of the two, right? That's just how it goes without being full of jargon or full of mess. And I'm not for it. I'm just looking at it from the market perspective so we can see what's going on. One, the standard deductions increases. So more money becomes untaxed. That's what's happening right now, right? And we just talking about face value here, y'all, right? More take-home money, less money sent to the government, higher disposable income. And that's what matters here. The benefits the middle-class earners the most, not the ultra-wealthy, because they get theirs in other ways. Hear me here. We're talking about tax-free tips, tax on overtime. We're talking about different things, right? Then we're talking about the child tax credit boost, right? Direct offset against taxes owed. This is something that is beneficial to people. Again, we just saying how this is going to put more money in certain people's pocket because it's an underline to something else. Meaning, families don't just owe less, they actually often get cash back. Historically, child credits increase consumer spending, support retail, housing, and services. So we know for a fact, what is this going to do? It's all about getting you to spend more money, y'all. Then you got the SALT cap relief, right? This matters in high-cost states. Remember, states where it costs a lot. California, Texas, right? It allows higher deductions of state and local taxes. I'll say that again. It allows higher deductions for state and local taxes, more retained income for professionals and homeowners. The money usually flows into stocks, real estate, business investment. This is just data. This is just not me coming up with this, y'all. Because what happens is it's disguised as ways because they know that people have bad habits, behavioral finance, right? Now, I'm not saying that the big, beautiful bill is beautiful. I'm saying it's ugly. I'm just saying they know that people are going to take that money and spend it, and it's going to go right back into the hands of the wealthy. This is a huge, under-discussed one. Now, seniors, spend consistently, invest conservatively but steadily, support dividends, stocks, bonds, and healthcare. This stabilizes markets during volatility. That's the senior deductions that they coming up with. The next one is auto loan deductions, where you get deductions on buying cars that's made in America. So it lower cost to finance vehicles. They're letting you write that off so they can try to get the American car market booming again. This supports auto sales, manufacturing, consumer confidence. These are the things they're trying to do. Again, I'm just saying, I'm not saying that this thing doesn't have a bunch of things that's going to hit us on the back end. I'm just saying they're going to flood money into the market by doing stuff like this because they know behavioral finances. So big ticket purchase returning equals economic momentum. This is the idea. Now, this is the one they sold everybody on. Tips exemption. No tax on tips. This directly boosts hospitality workers. They love it, right? Service industry income, they love it. This money spends fast, circulates locally, fuels small businesses. They know what they're doing, y'all. That's why I call it the big, beautiful bill. Because they want it to look beautiful on the front. Now, it's going to spank people on the back. But they know that money going to go into the system. They know people just care about the money that's in their hand right now. And number 7, we're talking about overtime exemptions. This is leverage on productivity, right? Workers now can take home more money per extra hour. They feel rewarded, not punished for effort. I remember when I was working on the stadium and we used to have to do double time, I'd be like, the double time just gonna pay all the taxes. So I'm still working 6 days. The double time, they just pay all the taxes. Nah, this improves morale, this improves spending, and this improves risk tolerance. Why? Because if people see more money, guess what they can do? They're willing to do what? Spend more money. They understand behavioral finance at a high level. The big picture is each policy alone looks small, but together, they raise net cash flow across multiple demographics at the same time. Families, seniors, workers, professionals. Now, this isn't about tax efficiency. It's about velocity. And that's how this game is played. Velocity is how fast money changes hands. Now that we took care of that, I'm going to get on a chart for a second. Because it's going to be important for me to show you some things that I think are about to happen in this market. Because when the government releases cash and reduces friction at the same time, assets move before people realize it. But I also feel, based on the chart, we got some things that we got to watch out for. But I also got to bring this last thing up before we get on the chart. Bear with me now. Bear with me. Y'all been rocking with me this long. We ain't got that far left to go. Now we have a Fed shift coming. Now, layer this on top of everything else. You have a Federal Reserve that is now printing money in the market, right? But you also have a Federal Reserve under Jay Powell that leaves out in May. And up until now, they've talked about cash getting into the system. Now we're talking about money conditions changing on top of that. This is what small moves turn into big market reactions. Now, we know that Jay Powell may get out. He's going to get out in May. What happens then? We get a Fed that's coming that's going to be more dovish. A dovish Fed going to print lower interest rates. Lower interest rates with oil. We know what's happening. Powell is exiting. New leadership is expected to be dovish. Political pressure is clear. Lower rates, easier conditions. And there's a very specific window that the market is watching. May through December. Because once Powell gets out, now if you can get 2 more rate cuts in, and you can get 1 rate cut while Powell in, you're talking about 3 rate cuts, the market gonna love that. Trump's saying he gonna try to push to get the interest rates to 1. Economic data usually softens, labor numbers become more visible, and the Fed historically adjusts the course. This is what happens. Now, I don't think we're going to have a negative year, but I do think we'll have a slower year. And so what I want to do right now is I want to get on the chart and show you why I think the market could face something like we saw early in the year. Because a dovish Fed means what? Less focus on fighting inflation, more focus on supporting growth, more willing to cut rates, more willing to inject liquidity if the markets wobble. It does not mean free money like COVID, but it does mean the Fed stop being an obstacle. Now, let's stop right there and let's get in that chart right quick. Now, the first thing I want to do is look at SPY, right? I want to go back to something, right? And we're going to go back to this because we can't overlook this. We're going to look on a weekly. We got to go here because it's just important to do this, to start from here. And I'm going to keep saying this and I'm going to keep showing y'all this until y'all see it. We know what our marks is that we paying attention to. This was the COVID low. This was the high. This was the low. This was the low. This was the bounce down. This was Joe Biden's market. This was the Trump tariff liberation day low, right? Now, I want to do something. Now, if we get closer into this, notice how we got really close here. Right? We got there, then we fell off. Now, we don't have that much room going up there, right? And I keep saying this to us, like we only have, 1%. We get to that 7,000 maybe, right? We only have that. And so that's going to be important for us to pay attention to because I truly think, and I'll say this, I've said it a million times until I'm proven wrong. If I'm proven wrong, I'm okay because I'm a bull and I can deal with it, right? All right, now we're looking at this on a weekly. Now, if we on a weekly right here, here's a couple of areas I'm looking at. First area I'm looking at is right here, 650, right? Right there, 651, 652-ish, right? The next area that I'm looking at is here. These two areas are essential for me to watch as I look at the market. Simple being because previous all-time high, then we fell, then we broke above it. Here we created support. We went all-time high. We created a support here. That's the Twin Towers. Now we here. So in my mind, here's what I think, and I'll say this again. I think we get to this 7,000 mark or close to it up here. And we got two ways to go. I think we bounce to 650, that gives us an 8% pullback. Or I think we come here, that 613 area, and we get like a 13 to 15% pullback. I truly believe we get that. I truly believe that we get that. All right, so now, if we go to the daily, I want to add this to it right here. I think our first stop would be here. I think our first stop would be at 673. Because remember, the market's not going to go straight down. I think our first stop would be at 673 at some point. And then from 673, I think we go down to 651. And I think right 651 is a deciding fact, like a line in the sand. But remember, I still think we get to all-time high. So I think we get to all-time. I think we'll touch 7,000 at some point. And I think then this becomes the level, the key level. I think we'll hit 690 unless we just hit that again and that becomes like this triple top. But I think we eventually gets to it or get really close to 7,000 and then we get a breakdown in what's going on the SPY. I just think this is important for us to see, right? Again, I think we come here and then I think we rally back. But I think the market has to sell off at some point. And I'm just seeing it. And I put a lot of cash on the side. I think we get to that. I think we get there, y'all. I think we get there. So let's just think about this. I mean, and then the closer we get to it, the market has to make a decision, right? And I'm going to show y'all how I feel about it. Think about it. From right here, let's say we get to 7,000. That gives us 2%, right? So we got 2% to go, right? We got about 2% from where we at currently, 3% to where we at currently. Right, we get to 7,000. That's how close I think we get to it, y'all. I think we get really close to that trend line and we just gotta respect what's going on. Let's go a little further. So let's go to the Qs right quick. I had some key levels marked off already on the Qs. And this was just essential to me. As I watch the Qs more, knowing that it's tech heavy and knowing that growth will probably have the first, fall. I think that when we look at the Qs, my first level would be this level right here. Right, this 580 level. I think this would be a key level for me on the Qs. I'll come up a little more here. They go 589. I like that area first and foremost. And then to see what happens from there. Now, if I put my tool on here, I want you to see something. Let me get the first one off. From high, the first fall there gives us 7%. All right? 7%. And then I think we can get this 15%. I think the market gives us that. I truly do. I truly do. Nah, I think we recover from it, but I think the market gives us that. And here's what's going to be interesting. So if you look from 2021, this previous high, right? Watch this. From this previous high right here, right? Let me circle. From this previous high right here, you get a run up and you create an all-time high, right? From that all-time high, I want you to see what happens. You come down You create an internal high and you come right back really close to what? That all-time high and then this internal high. You come really close. And then from there, you go back up, right? You create your highs. And then notice how this high right here, the April lows or the tariff lows right here, come back and touch that high again, right? They come back and touch that high, right? Dang, that's interesting, right? And then watch this. So we run all the way up. We run past it, then we get these highs. So, and then here is where our Twin Towers was created. We'll get to that. So I think if we come back to the Twin Towers, we come back to this major structure high right here, which was a previous all-time high. That's why I had that marked out. That's why I have that marked out, right? So I think we'll come here. You can see that's the Twin Towers. That's the Twin Towers. You already know we've been marking them forever, right? But I think we come to them Twin Towers, and I think we may come down and test this, and that'll give us our drop. That'll give us our 15%er. Wait, let me get it a little closer. Right there. There we go. That'll give us 14% from the high. That's cool. Let's see what 10% gives us. 10% gives no major structure, right? No major structural pattern right there. So I can see us come into here. And then, now mind you, remember all the big heads, Tom Lee, everybody that's bullish saying, yo, we think we'll have a first half of the year pullback, right? Now remember, you can average, the market average at least one, it's really 0.8. It's a 0.8 to 1%, 10% pullback a year, right? You get about between 3 to 5%, you get about 2 to 3 of those a year, and you get one 10%er. And so I think that can happen, y'all. I think that can happen. I think that puts us right in a specific place. Let's go a little further right quick. So right now we're looking at MU, right? And I was telling my people this in my Patreon. If you want to come join us, we'd love to have you there. Right, and I've showed you this chart before. So we see MU, it was outside, and I told like, yo, I don't want it outside of there. But now it's broken back inside of the trend line. So this is why we respect it. See, it broke outside of the trend line, right? If we mark it out, right? Broke outside of the trend line, came here, right? Got to it, rejected, and gapped up Friday. Right? So it got inside the trend line. That is really, really good. So here's what I say. If I'm looking at MU, I'm saying it can go from here to here. It can give us another 5%. It can give us another 5%. Then I will be looking at, hey, okay, so if I'm looking at MU in my mind, I'm saying it can go to 135-ish. Before I would get concerned. So anywhere in the 130 area. So I think, MU, I think we can get another $15 out of it before we start looking at caution. It's back inside the trend line, solid confirmation inside of there. I love it. I'm not mad at it. I like what it's doing right there. And if I went to the weekly, and if I had to say trap, what do you think it'll come back to? I think we could come back to here. I think that would be a good play. 258. Yep, 258 is what I can see it hitting back to. 258, maybe right on top of that. 263-ish. Think it come back to 263. I'll find support right here. 279. I think that's it. That's it. They could come back there, back outside the trend. I think that's what we go at with MU, y'all. A lot of people really love AVGO. I love AVGO as well. Right now, just looking at this, man, such a heavy situation, man. It's not, again, it's outside our trend lines right now. I don't like it. I would definitely have to see it get back at least on top of 373 for me to even find any interest in it. For my goal is not to get it below the trend line, right? Or get it below its 50 or its 20. So I would want to see it hop above 373, and you like, Trap, you supposed to get it at a discount right now. Well, that's true, but we see where it's trading at right now, right? And we don't want to really be in no part of that. We're not right now. We can definitely see this bear flag forming. We see that forming. That ain't even hard to see right there. That ain't even hard to see right there, right? We see that bear flag forming. That ain't hard to see, you know? That ain't hard to see. And so what do we see? Drop, base, was rising a little bit, and then we can see that next drop. And so I can see it coming from 347. I can see it coming from 347 to 324. And then once it gets to 324, then I can see it popping back up. But that's what I can see happening right there. And it's just clear as day. This ain't me trying to be, we see that, man. Right? And then this last candle, Friday, it shows us that. If we look at this last candle, Friday, I'll take this off the screen. If we look at this last candle Friday, look at that. Rally, reject. Bearish candle right there. That's bearish. That's bearish right there. So I don't want really no parts of that right now, y'all. I'll talk about a play that I took a loss on this weekend, Friday. As we can see, I was in this Tesla play. Notice I was talking about it a while back. It was above here. It was inside of here. It was consolidating. And then once it broke through my candle, I let it get all the way through. Once it broke through my first candle, I should have just got out of it. But I thought it was going to kind of bounce back. I didn't pay no attention because I was like, yo, it's in, slow weekend, but holidays. But once you saw this one candle, it couldn't break after 1, 2, 3, 4. Because I got it on a break right here. 475, we got in it. But 1, 2, 3, 4, 5, 6, 7, 8 days, it couldn't create a new high. It couldn't break that 500. I should have got out of it. But I waited and I told myself, I was disciplined. I said, hey, if it breaks my candle, I'm getting out of it. But I wasn't disciplined as I should have been. I let it break. Once it broke, I let it go 3 more days. And then Friday, I said, all right, I got to get out of it. So I did take an L on that. We took a win on ASML. Took a big win on ASML. Good win on ASML. We got all of that. Cashed out of the ASML play simply because it's in discovery now. New all-time highs in discovery. So we took the win on ASML and the Patreon. We took the loss on Tesla. I'm good with that. I don't have a problem with that. Starting off the new year that way. All right, man. So here's what I just want to leave y'all with before we get out of this, man. The markets don't really need the Fed to help them. They just need the Fed to stop hurting them. That's it. That's the shift. With this invaded Venezuela, we understand that it's a power game. It's all about power. So don't get caught up in all these headlines. Don't get caught up in your emotion about everything that's going on. It is what it is. Let's focus on what we can focus on. Right now, markets are pricing a strong chance of 2, 3 more rate cuts. They won't see that happen because rates, it's the price of money, y'all. And that's what we want. We want to be a part of this game and we want to make some money because we understand that the game wasn't written for us to win. We understand the game wasn't written for us to succeed. We wasn't in the process of this game. We wasn't in the thought process. We wasn't in the rules and we wasn't in the regulations. But damn it, we're going to be a part of it now. And we're going to take advantage of it. And we're going to use this game to turn our last name into assets. We're going to trade and make some money. We're going to buy and hold. We're going to make some money. And we're going to take advantage of it. We're not going to keep falling victim to the same thing over and over and over again. And so it's your boy, the Wall Street Trapper. Make sure you like, make sure you subscribe, and make sure you share this video with somebody you know for a fact you want to make some money with. Salute.